In the world of finance, making a wise investment can transform a modest sum into a fortune. This statement holds immense weight and truth, and it's the foundation of intelligent investing. The art of investing wisely is not just about making quick profits. It's about understanding the market, having a long-term perspective, and making informed decisions based on sound financial principles. One such principle is the cornerstone of a book that has shaped the world of investing. The book is none other than The Intelligent Investor by Benjamin Graham. Considered as the Bible for investors, this book provides timeless insights on investing that continue to be relevant even in today's complex financial landscape. Benjamin Graham, the author of this masterpiece, is no ordinary man. He's often called the father of value investing, a strategy that involves buying stocks that appear underpriced by some form of fundamental analysis. Graham's reputation in the investment world is unparalleled, and his teachings have influenced many successful investors, including the legendary Warren Buffett. Buffett has often credited Graham's book as the best book on investing ever written. The Intelligent Investor is not just a book. It's a comprehensive guide that lays out the foundation of investing. It teaches you how to approach the market, how to analyze stocks, and most importantly, how to develop the right mindset for investing. It's not about predicting market trends or timing the market. It's about disciplined investing based on sound financial principles and a clear understanding of what you're investing in. This book is not just for seasoned investors. Even if you're new to investing, Graham's teachings can provide a solid foundation to start your investment journey. The principles and strategies outlined in this book are timeless, and they are applicable in any market condition. With this book, we delve into the wisdom of one of the greatest investors of all time. It's not just about making money, it's about understanding the process, developing the right mindset, and making intelligent decisions. As we move forward, remember this: investing is a marathon, not a sprint. And the key to success in this marathon lies in the wisdom shared in The Intelligent Investor by Benjamin Graham. Graham begins by distinguishing between investing and speculation. It's a crucial distinction that can mean the difference between building wealth and losing it. In Graham's view, investing is an approach that promises safety of principle and an adequate return. It is methodical, disciplined, and long-term oriented. It involves thorough analysis and ensures that the investments are sound and the price is reasonable. On the other hand, speculation is akin to gambling. It's based on hopes and dreams of big, quick returns, often without a solid understanding of what one is getting into. Speculation operates on the principle of buying with the hope of selling at a higher price, and it often ignores the intrinsic value of the asset. This distinction matters because it underpins how we approach the market. An investor operates with a margin of safety, while a speculator takes on more risk. The takeaway here: being an intelligent investor is all about focusing on the long-term benefits, not short-term gains. Inflation, an investor's invisible enemy. Every investor must understand the concept of inflation. It's like a silent ghost, quietly eating away the real value of your money over time. Imagine this: you have $100 today, but due to inflation, the same $100 might only be worth $90 next year. Benjamin Graham, the author of The Intelligent Investor, offers valuable advice to tackle this ghost. He suggests that an intelligent investor should always consider inflation when making investment decisions. Investments should be directed towards assets that have the potential to beat inflation over the long term. Stocks, for instance, are often seen as a good hedge against inflation. They tend to increase in value over time, outpacing the rate of inflation. But remember, while stocks can provide a hedge, they also come with their own set of risks. Therefore, a balanced and diversified portfolio is crucial. An intelligent investor always keeps an eye on inflation. Graham proposes a defensive approach for the average investor, an approach that is as timeless as it is smart. Let's delve into what this entails. First off, let's understand what we mean by a defensive investor. A defensive investor, according to Benjamin Graham, is one who is not looking to beat the market. They are not looking to spend a lot of time and effort on their investments. Instead, they are looking for a good return with minimal effort and minimal risk. Now, how do we achieve this? Graham suggests a well-diversified portfolio. This means spreading your investments across different types of securities to reduce risk. Imagine not putting all your eggs in one basket, but rather in several different baskets. If one basket falls, you still have the others intact. That's the essence of diversification. Graham advocates for a mix of high-grade bonds and leading common stocks. He suggests a split that could range anywhere from 50-50 to 75-25, depending on the investor's risk tolerance and market conditions. The art here is to strike a balance that suits your comfort level and financial goals. Now let's talk about safe stocks. What exactly are safe stocks? Well, these are stocks of companies that have a long history of stable earnings and dividends. They are usually large, well-established companies that have stood the test of time. These stocks are less likely to be affected by market volatility, making them a safer choice for the defensive investor. So, what's the advantage of this approach? The defensive approach is designed to protect the investor from serious errors and to promote decent returns with minimal effort and capability. It's an approach that is especially suitable for those who are not comfortable taking big risks or who do not have the time or inclination for active investing. Remember, in the world of investing, defense is the best offense. It's about safeguarding your money while ensuring a steady growth. It's about being smart, not just being brave. It's about playing the long game rather than chasing quick wins. It's about being an intelligent investor. The margin of safety is the secret ingredient of successful investing. A seasoned investor knows that investing is not about predicting the future, but about being prepared for it. This is where the concept of the margin of safety comes in. Conceived by Benjamin Graham, the father of value investing, the margin of safety is the difference between the intrinsic value of a stock and its market price. So imagine you're in a marketplace. You see a beautiful antique clock that you believe is worth $100, but the seller is asking for only $50. That $50 difference, my friends, is your margin of safety. It's the cushion that protects you if your estimation of the clock's value turns out to be overly optimistic. In the world of investing, the margin of safety acts as a buffer against financial loss. It's like a safety net that catches you when your initial investment calculations miss the mark. You see, the market is a fickle creature. It can be influenced by a myriad of factors, many of them unpredictable. So, when you buy a stock at a price below its intrinsic value, you're essentially giving yourself a safety cushion in case the market takes a downturn. But why is this concept so important? Well, investing is inherently risky. However, by applying the margin of safety, we can significantly mitigate this risk. It allows us to make investment decisions with more confidence, knowing we have a buffer to absorb potential losses. In essence, the margin of safety is an investor's best friend. It's a principle that encourages discipline, patience, and prudent decision-making. It's about buying a dollar for 50 cents, minimizing risk and maximizing return. Remember, in investing, it's not about being right all the time. It's about being right enough times that you come out ahead in the long run. And that's where the margin of safety comes in. It's not a guarantee of success, but it certainly improves the odds. The margin of safety is the buffer that keeps the investor safe from financial ruin. The Intelligent Investor is not just a book, it's a roadmap to financial success. And as we conclude our journey through this map, let's take a moment to reflect on the key takeaways that can guide us on our path to financial wisdom. Firstly, the book underlines the importance of understanding the difference between investing and speculating. Investing is about buying value, not just buying shares. It's a long-term commitment requiring patience, discipline, and the ability to ignore market noise and focus on the fundamentals. Secondly, the book introduces us to the concept of inflation. Inflation is the silent thief that erodes the buying power of your money over time. Therefore, any investment strategy must take into account the impact of inflation. Thirdly, the book advocates a defensive investment approach. This approach emphasizes diversification, buying quality securities at reasonable prices, and holding them for the long term. It's not about timing the market, but about timing the market. Fourthly, the book introduces the concept of the margin of safety. This is the difference between the intrinsic value of a security and its market price. The larger the margin of safety, the lower the risk. It's like a safety net that protects you from the unpredictable nature of the market. Lastly, the book reminds us that investing is not just about making money, it's a means to an end. The end being financial freedom and security. It's about making your money work for you instead of you working for your money. It's about building wealth slowly, surely, and sustainably. In essence, The Intelligent Investor is a guide to wise investing. It's about understanding the market, understanding yourself, and making decisions based on facts, not fear or greed. It's about being rational, not emotional. Investing intelligently isn't about getting rich quick. It's about getting rich surely. Remember, the intelligent investor is the one who invests with his head, not with his heart.